Hey guys, it's Stephen from HDQ Chartered Accountants, and today I just want to talk about self-managed super funds and how we can use them for property investment. So the idea is your money is currently parked in a retail super fund and you don't really like the returns that they're giving you, you don't like the fees you're being charged, you don't believe in it, you reckon you could invest better. So what we can do is we can set up a self-managed super fund and then we can use it to invest in whatever we want. But today we're going to talk about using it to buy property. So a good time to get started is if you want to get your foot in the door with a low value property around 500-600k. I would say about 150k balance is sufficient to get started. The idea behind it is we're going to need a 20% deposit, 20k stamp, 5k incidentals, and a little bit of a cash buffer to manage the ongoing cost of the fund itself. So reach out to your accountant or financial advisor, get the structure set up. If you're going to be using it for property investment, what we'll need is we'll need the self-managed super fund itself and a corporate trustee, and we'll also need something called a bare trust and a second corporate trustee. This is because the loans under a super fund are a little bit special. They're referred to as a limited recourse borrowing arrangement. And what this means is if you default under a loan held by the SMSF, it means the bank can only seek recourse over the property and not the other assets that the fund holds. So you might have some term deposits, you might have some shares and some property. Say you defaulted on the property, the bank can only seek recourse on that property. So basically, why we need the bare trust, it's basically a holding entity to segregate the property from the rest of the assets of the fund. So what you would do after you set up the fund, you would organize your money from your retail account to be rolled over to your self-managed super. During this time, you can speak with your mortgage broker to get your pre-approval. And the great thing about self-managed super fund is there's a separate borrowing capacity from you as an individual. Because it's a separate entity, the easiest way to think about it is it's basically a business. And the purpose is to save for your retirement. And any earnings or that are in the self-managed super fund cannot be used for immediate benefit. So they will be reinvested and carried forward until you retire. A common retirement strategy is buying a property around your late 30s, early 40s, when your super naturally hits about the 150 mark. You can buy a small value property between 500-600k. You can sit on it for about 20 years and see how much capital appreciation you've earned over that period in time. So during the time that you hold the property, the super fund tax rate is a flat rate of 15%, which is really great if you were to invest under your own name and your marginal tax rate is already at 47%. But if we hold the property all the way to retirement and we sell it after we've retired, there's potential there to actually get most of the capital gain or not all of the capital gains tax-free. That's because after you're retired, the tax rate in a self-managed super fund becomes zero. So it can be a great way to boost your retirement savings. If you're a believer in property, you don't really care for what the retail funds invest in. Primarily the underlying investments would be shares. So if you want to set up a self-managed super fund, consider it around the 150k mark, and naturally your borrowing capacity is separate because it's a separate entity to you. For borrowing purposes, what they will consider is your superannuation contributions, which is the income of that business, and also the expected rent from the property that you intend to purchase.